now starving the repo markets of liquidity. So if you look at the Treasury General Account, which is the Treasury's account at the Federal Reserve, that is now testing $1 trillion. So this is money which is being sucked out of the system. And therefore, markets are short of liquidity. Therefore, the Federal Reserve should be acting. But the strains in the repo market is an alarm bell to the Fed, and hence the Fed has been forced into action. Asset markets are still going to be short of cash.
So is quantitative easing going to be back in 2026?
Well, my answer is absolutely yes.
Hey, everyone. Very soon after I recorded with Michael Howell in late October, we had a policy change announcement from the Federal Reserve that the Fed would stop reducing its balance sheet via QT or quantitative tightening starting on December 1st. I wanted to have Michael back on to see how he expects this policy change to affect his readings of Fed liquidity and his outlook for markets. Also, the 20% discount to an annual subscription for Michael's Capital Wars Substack, where he tracks and interprets his liquidity readings, that discount is ending on November 12th. So those who are interested should consider acting now before the deal expires. Let's get into it. I'm joined once again by Michael Howell of GL Indexes and the Capital Wars Substack. Michael, great to see you again.
Well, Jack, very good to be here again.
The reason why you're back so soon, Michael, is because we have some news. So we did in late October an interview. You said you were seeing some concerns in liquidity, in particular in the Fed liquidity. Probably about a week later, we saw some severe strains in the repo market with various interest rates spikes showing funding strains. And actually on the October 29th Federal Reserve meeting, the Fed announced that it is ceasing quantitative tightening starting on December 1st. And it is widely rumored that it is going to start expanding its balance sheet as soon as 2026. So let's just, how have you processed the past two news coming out of the Federal Reserve and its plans for the Federal Reserve balance sheet, which is so key to what you follow and track at Capital Wars and GL Indexes?
Well, I mean, I think it's been pretty inevitable. I mean, the fact is there have been shortages in US money markets, which the repo spike really picks up. And that's been underway, largely since the Treasury General Account, which is the Treasury's account at the Fed, has already been built up again. So effectively, that's taken liquidity out of markets. And that starving of markets of liquidity has caused shortages in the repo markets, and consequently, rates have spiked relative to the Fed's target rate, the Fed funds. So I think that's that's pretty much given. I think therefore it's been no surprise that the Federal Reserve has had to sort of backpedal a little bit in terms of its policy. Jay Powell, actually a few days ahead of the FOMC, kind of foreshadowed that we'd see the end of QT. I mean, he more or less said that de facto. Now we've got the FOMC statement. I mean, they're indicating that's going to happen from December 1. But more particularly in the sort of the presser and some of the subsequent interviews, there have been hints that they're going to start increasing the balance sheet. In other words, increasing the SOMA account and their treasury holdings by maybe $20 billion a month net, which adds up to about $250 billion a year. So these sound, quite meaningful amounts. I mean, the unfortunate thing is that they're probably still not enough. And, if you look forward into 2026, we've still got a relatively low trajectory for Fed liquidity. And that clearly matters. I mean, it's putting unnecessary strain on the system.
Were you surprised, Michael, by the announcement that the Federal Reserve would stop reducing its balance sheet on December 1st?
I think the suddenness of the change, yes, absolutely. But the fact that they had to at some stage move in this direction was not a surprise because it's been coming. The simple fact is that markets need liquidity and the Fed really had to meet that. But the timing was actually kind of sudden. It was foreshadowed by Jay Powell a few days before the FOMC, where he more or less said de facto QT is over. But the FOMC was pretty clear that December 1 is the end date. And what's more, in the presser afterwards and in subsequent press interviews, there were hints given that the Federal Reserve will be issuing maybe something like $20 billion of liquidity into markets through purchases of treasuries. So they're actually going down the track explicitly of QE. And, people in the know, people like Laurie Logan, who used to run now at the Dallas Fed, used to run the SOMA account at the New York Fed. She pretty much said that QE will restart if there are tensions in repo markets. Well, there are tensions in repo markets. And that's what we've been predicting for some time because of the shortfall in bank reserves. And that's really been a consequence of the gyrations, if you like, in government this year with, first of all, the debt ceiling and now the government shutdown. Both of those have led to significant twists and turns in money markets, but they're now starving the repo markets of liquidity. So if you look at the Treasury General Account, which is the Treasury's account at the Federal Reserve, that is now testing $1 trillion. So this is money which is being sucked out of the system. And therefore, markets are short of liquidity. Therefore, the Federal Reserve should be acting. But the strains in the repo market, where repo rates, which are market-based rates, are trading significantly above Fed funds, or have been trading significantly above Fed funds, is an alarm bell to the Fed, and hence the Fed has been forced into action. It's a big deal psychologically,
Yeah.
for sure, because they painted themselves into a corner where they basically said, we're not going to do this again. And clearly they are doing it. And they're not just ending QT, but they've alluded to the fact they actually want a balance sheet expansion, or they probably will have to have a balance sheet expansion. That's for sure. And the fact is that was anyway sort of that's been written in stone because that's the way the markets work. They need liquidity. So the Fed is recognizing that fact. Qualitatively, that's a big step. The problem is that they're not really doing enough. So yes, it's a surprise. The timing is a surprise. They've done it quickly, but the fact they had to do it at some stage is not a surprise.
And you titled a recent report, Jay Powell, pick up your phone. Do you think that he has picked up his phone with this announcement that the Federal Reserve's balance sheet will stop shrinking on December 1st?
Yes, I think qualitatively this is a big change. I think qualitatively the Fed, who have been denying for a long time that they would ever get back into the QE game. I mean, so much so they're even suggesting or hinting that this is not really a QE. It's what we sort of tongue-in-cheek call a not QE. In other words, it's a liquidity injection, but it's not designed for the economy. It's designed to stabilize financial markets. But the trouble is you can't really fine-tune that fact anyway. If you put liquidity in, it goes somewhere, and it ultimately goes into financial markets. And so this has been more directed at financial markets to try and stabilize them. But that's needed. I mean, at the end of the day, markets are essential for debt refinancing. And there's a huge amount of debt to refinance, which is why they've got to preserve the integrity of the Treasury market and ultimately the repo markets.
So, Michael, yeah, a lot of Federal Reserve people would take issue with calling potential liquidity injections quantitative easing because, just to break up the term, quantitative has to do with the quantity of reserves. Anytime they buy things, they expand their reserve base, and then the easing is what they're buying. So, if they're buying a risky asset like toxic assets during 2008, that is incredible help and net easing to the financial system because you're taking a super risky asset out of the financial system. Even agency mortgage-backed securities, which is by that, it's also easing financial conditions, driving spreads way lower, driving prices up, spreads lower, yields lower. Longer-term Treasury securities also driving yields lower. So QE is totally buying risky things that have for the Fed. Longer dated securities and agency mortgage-backed securities with the goal of easing financial conditions. But if they're just buying, a 3-month Treasury bill, is that really quantitative easing? It's quantitative, but is it easing?
I think it's been kind of dancing on the head of a pin in many cases here, because the definition has been changed several times ever since sort of Bernanke first came out with it. I think if you put the current policy, if you showed it to Bernanke, 10, 15 years ago, he would say, well, that's plain and simple QE. But I think that the Fed has sort of finessed this to their own advantage over the years. But I think you can divide QE into two dimensions. I mean, there's a credit transformation there, as you rightly say. So that could involve buying impaired securities and bolstering the market in that sense. The other thing is basically a maturity transformation and trying to do something on that score. So if you look at those two dimensions, it's certainly not at the moment a credit transformation, but it is a maturity transformation. They are adding liquidity into the system. Now, they've actually the hints that have come from the Fed would suggest that because this is them buying Treasury bills supposedly it's nothing to do with liquidity expansion. I would deny that, pretty rigorously. But the fact is that they choose to call it not QE, so let's call it not QE. And that's probably a decent compromise. It's certainly adding liquidity into the system because Fed liquidity, on my definition, is expanding, and money market liquidity will go up, and what's more, bank reserves will go up. So all those factors tick those boxes, would suggest that the Fed is adding liquidity to markets. There's no question about that.
So is quantitative easing going to be back in 2026?
Well, my answer is absolutely yes. I mean, they more or less said they're going to do that. As I said, there may be finesses that they can argue that it's not, because it's not directed at the real economy. It's only involving treasury bills. But as I say, that's sort of dancing on the head of a pin in many cases. The fact is that Fed liquidity, on my definition, goes up and bank reserves will rise. The problem is that bank reserves will still, at the end of the day, even after these measures, be below the adequate level that they previously were at, which is about 3.3 trillion. And it may well be that as the year unfolds and the real economy, begins to recover further, that the level of minimum bank reserves is actually higher than 3.3 trillion. It could be nearer 3.5. So targeting levels, which the Fed had been doing at around 2.7, is indicating a big shortfall in repo, potentially in repo, which is why repo spreads have started to blow out.
But Michael, you said that it is maturity transformation, but if they're using an overnight reserve to buy a 3-month or even a 9-month treasury bill, isn't that a pretty low amount of maturity transformation? And Michael, I know in your indices, a huge measure that you measured a huge surge in liquidity in 2023 and 2024, and a lot of that was the shortening of the treasury issuance. So treasury going from longer term bonds to shorter term bills, on net. So if that's an easing, wouldn't buying treasury bills be way less of an easing as well?
Well, there are two ways to judge this. I mean, one is to look at the average duration of debt that the private sector holds at the end of the day, and one's got to, I think, wrap the Treasury and the Fed together here and look at the net change. And if you've got a situation whereby both the Fed or the Fed is buying bills and the Treasury is issuing a lot of bills, overall the private sector may well still see the duration of its portfolio drop. And if the private sector, which it does, has a duration target, that lower level of available duration will force the private sector to bid more aggressively for longer duration instruments, things like equities or tech stocks or Bitcoin or whatever, and the price of those assets will go up. So, that's the mechanism. The question that we've really got is this genuinely a QE? And I would say, yes, it is, for those reasons. What's more, if you look at issuing lots of bills, and those bills are bought by banks, not just the Fed, but other banks, private sector banks, that is clearly a monetization of the deficit, and that is creating lots of liquidity. But the difference is that liquidity is being channeled more and more into the real economy. And this is a lot like the situation that we saw during COVID. And during the COVID years, and let me contrast the COVID years with what happened basically in the wake of 2008. What you saw in 2008 and in the COVID period was an expansion in Fed liquidity. And actually, our general global liquidity metrics were elevated. But the fact is that in the COVID years, a lot of that liquidity also found its way into the real economy. And so what you had was an inflation problem in the wake of the latest liquidity surge post-COVID, but you didn't have it after the GFC because money then stayed in the financial markets. It didn't go out. And the Treasury, or the connection between the Treasury and the private banks, was really instrumental in getting traditional money supply measures growing fast. And it was that which was really the transmission mechanism into higher inflation. If you go back to the earlier years, post-GFC, money supply growth wasn't anything like as rapid. Today, it's likely to be. And as I've probably already noted, if you've got a situation where something like, let's say, half or circa half of the deficit, let's say, is being funded in the bill market, then you've got a problem with monetization because you're getting money supply growth increasing probably at a clip which is somewhat beyond the level consistent with a 2% inflation target. It may well be that you're looking at broad money growth in the US in 2026 of nearer 8%.
Well, so Michael, you
Now,
say that that sounds like a problem, and it ultimately will be a problem. Money growth, reckless money growth does lead to inflation, but it can feel pretty good on the way up in terms of the real economy and in terms of financial markets, right?
yeah, absolutely. There's no question about that. But I think the issue is what I'm trying to say is that we're transitioning from Fed liquidity towards more Treasury liquidity, if you like, or
Mhm.
Treasury QE. That money is being directed into the real economy. The real economy. I mean, I'm optimistic on the real economy in the US. I'm not in the camp of a lot of economists who argue that we're about to hit recession. I mean, after all, that's been a sort of cri de coeur of many people for much of the last 12, 18 months. It hasn't
Mhm.
transpired. The
Yep.
economy's been pretty robust. And I think there is every sign that maybe we're getting a pickup, as we speak. The economy does seem to be more robust. I think in 2026, it could continue in that vein. And one of the things that's helping to drive it is this Treasury QE. And effectively, what you're seeing is the administration is trying to get the Federal Reserve not to add too much liquidity to financial markets for the simple reason that this creates asset price inflation and is the instrument for a very significant wealth divide, a societal fracture in the US and in other countries. And they want money to go into the real economy. And I think that's really the strategy. That's what's going on. But as you get that transition, and everything that we're hearing from the Fed is still consistent with that, all we're talking about is the relative speed here. Um, that transition is going to be pretty tricky for Wall Street to handle because they've only known one direction, which is upwards, being supported by a rising liquidity pool. And that rising liquidity pool ain't there anymore.
So, Michael, on the one hand, we could say Michael Howell says not QE, QE is back, or Michael Howell says quantitative easing is back in 2026, and that, but that might imply to some people watching this right now that your views on fundamentally where liquidity is headed and its consequences for asset prices have changed. But I don't think is that the case, Michael?
No, I mean I'm still pretty cautious because I think that the scale of this Fed liquidity improvement is still insufficient. You'll still see problems in repo markets. There's still a shortfall of bank reserves in my view. And what's more upcoming, there's an awful lot of funding to do as the maturity wall hits and debt has to be rolled over again. And that's really the problem. So I think that there are problems out there. And the Federal Reserve needs to do a lot more in terms of quantitative easing, and I just don't think they have the stomach for that, particularly given the stance of the administration. It doesn't change our overall view of liquidity because anyway, our concern or maybe our projection was that the liquidity cycle globally was likely to inflect downwards sometime from late 2025, maybe early 26. I mean, that's what the cycles would seem to suggest. And therefore, the Fed's struggles, if you like, at the moment pretty much fit into that particular frame. What the Fed is suggesting, which is kind of fine tuning in a lot of ways, is not going to make a lot of difference to that. I mean, it's not as if the Fed is flooding the system with more liquidity. They're really doing enough, the sort of de minimis, you would say, necessary, or maybe even a tad less than that. And the sort of numbers that the markets need for next year on our calculations would be near a sort of 400 maybe 500 billion US dollars. And so the number that's coming in is is something like half that. So we're still gonna get pressures. I mean, it may be taking some of the immediate strain away, but we're still in a period where liquidity looks relatively scarce.
Mm. And Michael, what's your read of what's going to happen to the Federal Reserve in 2026? Powell is leaving. A lot of people who are on the FOMC are leaving as well. Who do you think is what direction is the Fed going to take in 2026? Do you think? And what's your read of the current personnel situation in 2026?
Well, I think this is the most central question that we've got to pose for next year is the composition of the FOMC in the light of what could prospectively be an emerging inflation problem. And the reason that, as I say that, is that because so much of the deficit is being monetized, and despite the words of Scott Bessent, maybe 12 months ago that he wouldn't go down this Yellonomics path, he has done, and there's a lot of bill financing. And that basically means ultimately means monetization of the deficit, which doesn't end well because inflation picks up. Now, let's look at the composition of the FOMC in that light. Will Jay Powell exit, as you say? That's not guaranteed. His term as Fed chair ends, but he's still sitting on the FOMC. It's been traditional for the Fed chair when his term ends for him to leave the FOMC, but that is not a given. He could be mischievous and decide he wants to stick around. So there's that. There's the Lisa Cook question. But then, even aside from that, Trump has got some of his appointees on the FOMC. And the question is, what would they do in the context of rising inflation? Now, I would like to think that they would basically become tough and raise rates to try and fight off inflation. The impression one gets from, let's say, the Trump end of the FOMC, Stephen Miran, that maybe they won't be doing that, and they want much lower interest rates. And the view that Stephen Miran has, rightly or wrongly, is that rates are still way too high and they need to be lowered. Now, if that is what happens next year, and you've got this emerging inflation problem, then the dollar is going to be the soft spot. So that's what's going to give.
You write that while these actions are a welcome positive step and may slow the decline of the global liquidity cycle, they are not enough to prevent its upcoming peak. We conclude that the Fed's new stance is more consistent with a range-bound stock market, but investors should remain cautious and alert. It is late cycle, so it hasn't really changed your view, because a lot of people think that this is a big deal.
Not at all. Well, I mean, it's a big deal. It's a big deal qualitatively because I think at last the Federal Reserve is formally recognizing the fact that liquidity is critical to markets. I mean, that much is important. I'm sure they knew that anyway. But in terms of their public face, that's what they're saying. We need liquidity. The markets need liquidity. This is somewhat different from a sort of straightforward QE exercise. It's much more a technical operation to try and support the markets. And I think people go along with that. The question is that quantitatively, it's still not enough in our estimation. And the thing you've got to remember is that the economy is still expanding. In actual fact, even more than that, if you look at the latest, Atlanta Fed GDP now, they're suggesting Q3 could be a 4% print for US GDP, which is going some. So in actual fact, the demands of the real economy over the next 12 months for liquidity are going to be up there. So the sort of figures that we're projecting for next year, that money is going to be absorbed out of financial markets and drained into the real economy. So asset markets are still going to be short of cash.
Michael, I recently interviewed Fed Governor Steve Myron, who made the case that actually just because the Federal Reserve is stopping the reduction in its assets, the composition of the assets is going to change, and it's going to continue rolling off mortgage-backed securities, and with that cash is just going to buy treasury bills. So is that conversion of mortgage-backed securities that are rolling off into treasury bills, would you agree that is a significant liquidity drain that is unchanged, or do you disagree with Fed Governor?
Well, I don't disagree. I mean, the fact is that the scale of roll-off of mortgage-backed securities is not really affecting the situation too much because these are very, very long-dated securities. And, they're effectively dribbling off the balance sheet. So they're not really causing a big problem. Were they dumping mortgage-backed securities in one go onto the private sector, given their longer duration, that would be a big duration hit and it would absorb a lot of liquidity out of financial markets. They're not doing that. They're clearly going down the track of treasury bills, buying treasury bills. That's important. But I think you've also got to put this in context and say that the problem here really comes from trying to manage a large federal deficit. And that's why we've kind of got into this mess in the first place. And the issue with a large federal deficit is that if you're funding at the long end, you're clearly going to absorb liquidity out of financial markets. And that's an issue. But on the other hand, if you start to issue a lot of bills, which is what seems to be the Treasury's preferred strategy is, to try and preserve liquidity as much as they can, even though, as we've said, it's currently quite scarce. But trying to preserve liquidity by issuing lots of bills is actually direct monetization, because the main buyer of those bills is not just the Fed, it's also the rest of the banking system. And any credit provider, Fed or private bank, that buys government debt is a monetization. And we know from history that this ends badly. So if you start to work through the math of a, 2 trillion deficit, you're looking at conventional monetary growth, which is going to be well, in excess probably of sort of 8%. Maybe we're nearer 10% next year, given this degree of monetization. And although on the face of it, you might say, well, that's actually a lot of extra liquidity for the markets, the fact is that that's inflationary. And the real economy is more likely to get or feel the benefits of that. And as we've said, this sort of shift that we're getting, this tactical shift from Fed QE to Treasury QE, is much more beneficial for the real economy than it is for financial markets. After all, strong economies don't always have strong financial markets, and we've got to remember that.
Michael, how do you estimate adequate level of reserves, and why is adding a quarter trillion of balance sheet expansion next year, why is that not enough? You mentioned something about the economy is going to need so much liquidity, but $250 billion sounds a lot to me. Sounds like a lot to me.
Let's look at some of the
Yeah.
background. Let me turn to some charts. Let's focus on the problem first. This is looking at the SOFR Fed Fund spread. So this is, if you like, the barometer of tensions in the repo markets. The orange line is showing that spread. The scale is on the left. It's saying that typically, given the fact that SOFR is a collateralized rate, so this is the repo rate. So this is the rate that borrowers are borrowing against collateral. So it's a collateralized interest rate. Fed funds is not a collateralized interest rate. Therefore, you would expect normally that SOFR trades below Fed funds, which you can see for some of that period. The grey band that I've shaded there is illustrating what you might call a normal zone for that spread. And then I put a dotted line up there about 10 basis points over normal, which is then saying that's kind of a danger zone when you start to get twitchy or tensions, can be building. Now, it's not really the scale of those spikes that's so important. I mean, I'm not dismissing that, because clearly a big spike suggests a big shortage. It's much more the frequency of them. And what we're seeing is more and more evidence, particularly in the last 14 days, of significant spikes upwards above that danger zone on the spread. Now, that is really coming because of a breakdown in funding in the system. And as we say in the text at the top, this is reflecting either a lack of liquidity across dealer banks, or there's insufficient good quality collateral for borrowers to use. And it's really of those two factors, it's much more the former that's important. Now, if you look at the mechanics of the money market, what we've tried to show there is really the factors that are going into and out of US money markets. And what you've got is two major players here, the Federal Reserve on the left and the US Treasury on the right-hand side. Now, the Treasury is spending money. In other words, it's spending on wages, it's spending on infrastructure, it's spending on Medicare, it's spending on defense, etc. It's raising taxes and it's funding through debt issuance. And the net balance is really called the net balance appears as the Treasury General Account. That's, if you like, the balance of cash, the bank account that the Treasury holds at the Federal Reserve. And that is either money going into the markets or money coming out of the markets, depending on what the net balance is. But it's normally positive. And one of the features of the last 10 weeks is that the TGA has actually rebuilt significantly. And that has been partly a move after the ending of the debt ceiling. And then more recently, it's been because of the government shutdown. Spending has obviously been hit to some extent. So we're now looking at something close to $1 trillion for the TGA. Big number by historic standards. But that's money withdrawal from the system. And then you've got on the other side what the Fed can inject. And that is looking at things like Fed credit. It would include QE. It would include things like the standing repo facility. It includes discount window lending. And then subtracting money out of the money markets would be things like quantitative tightening, which, as we said, is just ended. The reverse repo program, which has actually now been pared down to virtually nothing. And those are really the withdrawals. So that's the balance of the money markets. And the net figure is what we term Fed liquidity. And you can see the definition there at the bottom. And that more or less equates to bank reserves. So if you think of the Fed liquidity being the net asset side of the balance sheet, bank reserves are the liability side. So effectively, that's how it works. But bank reserves are driven by Fed liquidity, and effectively bank reserves in aggregate are determined exactly by monetary policy, by what the Federal Reserve is doing. And you can see as well on that definition that we subtract currency in circulation. So as I said, if you get a stronger economy next year, you'd expect something like 120, 130 billion dollars to come out of Fed liquidity because of the needs for cash in circulation. Now, the overall global liquidity picture, which we need to assess, is actually been looking pretty good. And this has been the story all year, where you can see quite a strong trajectory in global liquidity. The problem is that good times often come to an end. And we've got to start thinking about that particular process. And that's what we've been trying to put into historic context. Fed liquidity, US liquidity is one component, but a very important component of this. And you can see ultimately, if you start to look at a rate of change of different measures, there are two that I cite here. There is evidence, this is looking at daily plots of our nowcast of liquidity beginning to roll over, and another measure of market liquidity. That's really a companion measure, a cross check, which is
Michael, I
looking at.
apologize. How is it that the nowcast daily liquidity has been declining over the past 2 months, but the weekly liquidity chart that you previously showed was one of the most up and to the right charts I've ever seen in my life?
Yeah, because this is looking at a rate of change.
Okay, thank you.
So this is much more about momentum. So what I'm saying is there's absolutely unambiguously the level is going up, that's for sure. But the rate of change of that is now starting to slow. In other words, growth at the moment in absolute terms is linear, and to get a continued fast rate of growth, you'd have to have exponential growth, and clearly we haven't got that. So what this is saying is the growth rate is beginning to come down now. Now, if you then look at this in general context, to plot this same daily chart, but over over decades, this is looking at that particular backdrop. And that's saying, here is the global liquidity cycle. And you can see that little blip down is the inflection beginning, we think, in our daily data.
And the
Now,
peak
I
of
mean,
sorry. The peak of that is not a peak in absolute levels of liquidity, but a peak in
it's
the rate of change
not.
of liquidity.
Absolutely, 100%. It's not looking at a level. This is looking at a rate of change. And that's what we find is most important in terms of a warning sign to how asset markets will change. So we look at rates of change, or momentum, which is what this is showing. So this is basically saying this is the picture that we're viewing. And the concern that we've got here is that what you've got is a situation where the Federal Reserve, which is often the leader worldwide, is beginning to see some inflection downwards in liquidity. Now, what I'll come on to a little bit later is another piece of evidence which has come through in about the last 3 or 4 weeks about what's been happening in China. And China has been a major engine of liquidity through most of this year. And I've gone into the reasons maybe before as to why that is. But we think one of the reasons that sort of jolted China into action this year to try and monetize its debt is the pending threat that is coming from US stablecoin. And China is, I think, perceiving, and certainly anecdote would support that it's perceiving, a major threat to the integrity of the Chinese monetary system from the introduction of stablecoin, in the future. Now, if we move on to looking at the length of the cycle, you can see here that the cycle is coming near its normal end. The dotted line there is the average cycle length over the period from 1970 to 2025. That typically lasts, if you look at the prior chart, it's about 65 months, and that's how it tends to be displayed. And what I've tried to do is just put the current cycle in that same context, and you can see we're sort of coming somewhat to the end of that normal phase. Now, what is the problem, and why are we concerned about developments? And it comes back to something I foreshadowed earlier on, which is saying, look, the reason that everyone is getting into a muddle here about the markets and about the tensions in repo really come back to this huge amount of debt that we're accumulating, which comes back to the size of government deficits. I'm not hitting on the US because everyone is in the same boat. In many ways, the US could be the cleanest shirt in the laundry, but you've got terrible debt problems and deficit problems really across the West in general. And one mustn't obviously exclude China from that. If you look at the centerpiece of that diagram, it looks at the interplay between liquidity and debt. And the point is that modern financial systems are debt refinancing systems. They're not about raising new capital for investment projects. They're all about essentially rolling over debt. Something like 3/4 to 4/5 of all transactions in global financial markets now is a debt refinancing transaction. So it's critically important. And that debt liquidity nexus is vital to understand, because what it tells us is that debt needs liquidity for refinancing to roll over the debt. But in turn, the paradox is that liquidity needs debt because liquidity is mostly collateralized borrowings. And if you look at the left-hand side, it says 77% of global lending is now collateral backed, which is a World Bank figure. Now, if you look at that nexus and the spiral that we're depicting here, the left-hand side is where you get a breakdown from the transition from debt to liquidity. That's the repo markets. In other words, borrowers are borrowing against collateral, and you would see tensions in two areas. One is through the move index, which is essentially the volatility of your collateral basket, and that would mean bigger haircuts and less borrowing. And the other is to say that there's actually just a shortage of liquidity in the system, which is looking at the SOFR spread, what we were looking at just a moment ago. So what does it mean? It means here that you can see we're moving into territory which looks to be ominously threatening. And this line is the ratio between advanced economies' debt and the pool of liquidity. There's an equilibrium there, or a normal level, if you like, where you get stability, which is about 2 times where the dotted line is. Anywhere significantly above that, you start to enter the realm of refinancing problems. Tensions begin to build because there's too much debt to roll over relative to the liquidity or balance sheet space that's available among credit providers. Every financial crisis, I would maintain, going back over those previous 4 to 5 decades, has ultimately been a refinancing crisis. If you look at the other side of that, in other words, a low ratio below that dotted line, when you've got a lot of liquidity relative to debt, so the ratio is below 2, then you start to see asset bubbles, because the surplus liquidity will find its vent in higher asset prices. And so you can see those earlier bubbles, and we've just come through, or in the midst of, what we call the everything bubble. Now, the problem is that that orange line, which is measuring the ratio, is now starting to move upwards. And that is indicating that we're going to get more refinancing tensions. So it's no great surprise that already you're starting to see problems in US repo. That's the leading market worldwide. So why not? And the reason that that orange line goes up is, number one, because central banks seem, less eager to start throwing money into the system. And, I've highlighted the risks of them doing that anyway, which is a future inflation threat. And that may well transpire, who knows, which would actually cause a significant revolt, presumably, by monetary authorities worldwide into even more tightening.
So going back to the repo markets, so in late October, early November, we did have a pretty substantial spike with SOFR, what, 25, 30 basis points above where it normally should trade. And I'll also note, Michael, that your chart showed SOFR minus the Fed funds rate, that spread. I would note that the Fed funds rate itself had a little bit of a spike of 3, 4 basis points up there. So in what
Yeah.
are considered to be the safest markets in the world, the collateralized and uncollateralized, overnight lending markets between banks, you're starting to see some distress. And, if a high yield bond sells off, the yields goes up 40 basis points, doesn't really matter. If it's some private credit loan that very rarely trades, gets marked at, and the yield spikes, it doesn't really matter that much. But this is the core market of the world. So this is a big deal, and the scale is just enormous. Michael, you noted in that chart that the repo tension appears to have eased, and we're now, SOFR is still above the Fed funds rate, but not by much, maybe, I don't know, 5, 10 basis points. Um, are your concerns allayed for now? And also, do you think that the standing repo facility, SRF, which the Federal Reserve established in September 2019 to deal with these issues, uh, is up to the job of containing this stress? And in particular, do you think that the take up of which, many billions of dollars, about $30 billion of take up was went into this facility on the last day of October 31st, the end of the month? Maybe there's some calendar issues there, but did the standing repo facility, has it worked as the Fed intended, and is everything hunky dory?
Well, I'd say if you look at things from the perspective of today, you'd agree that it's probably done its job, and the sofa markets or the repo markets look as if they've been calmed. I mean, what I'm trying to argue is that don't necessarily look at one day's rate. You've got to look at the pattern of these rates over a few weeks. And the fact is that it's, as I say, it's not the extent necessarily of the increases that are important. It's basically the frequency. And what we're looking at is a trend here, and that trend is building, and that trend is building because we've got shortages of liquidity. If you look at one day's repo print, you could say that maybe it seems as if things are calm again. So the standing repo facility has done its job. But as I've said, you can't just look at one particular day and what the extent of a jump, because this series by definition is jumpy. You can get sudden imbalances, but the question is the real question is, do they persist? And it's really looking at the trend that's important. And what we've got is a trend here that is showing building tensions in the repo markets. And we need to understand why. But I think just one point about the standing repo facility, and it hasn't really been truly tested. And one of the issues that sort of nags me is the fact that it's really involves a tripartite arrangements. And although that's a fairly technical point, it means that you can't really that a bank can't net off any borrowings, and that ultimately means that using the standing repo facility is absorbing balance sheet space, and that may cause banks to be reluctant. In other words, it has a cost for the bank, and therefore the bank may be reluctant to use that until the very last moment. And the reason that that's critical is that you could therefore see a sort of a building up of pressure and a sudden release with a huge demand on the repo markets, causing the spike like we saw in 2019. That's the risk. So I think the jury's out. But if we go back to the point about what's actually building here, and maybe why this is going on, maybe if I go on to maybe this chart, this is looking at banks' reserves. Now, banks' reserves are below average or below normality, let's say, and normality is shown by that dotted red line. Now, the dotted red line is measuring what I calculate as adequate reserves or minimum reserves, and that it comes out at about $3.3 trillion. Now, that's not the Fed figure. The Fed has a much lower figure, and the Fed's estimate is about 2.7 trillion. Okay, and we'll come on to why they may have got there in a moment. But why that matters is that my estimates derive from when you get tensions in the repo markets. So mine's a market-based estimate that is saying whenever you get tensions, that would suggest that banks have got inadequate liquidity. And when you've got repo spreads that are actually very low or depressed, that would suggest that banks have got decent or adequate liquidity. And that's how that dotted red line has been estimated. The actual is the orange line, and you can see annotations which show why there have been various spikes in that. And the latest jump down in banks' reserves is because of the TGA rebuild, as I alluded to. The dotted orange line are my projections of what now happens, assuming basically two things. One is that the excess in the TGA, the trillion, is pared back by about 150 billion back to the target the Treasury has of 850 once government restarts. The second thing is that I've assumed 20 billion in QE every month from January of next year. And still, you don't get back to that dotted red line. So you're still having a shortfall. And that would suggest that you're still going to get ongoing tensions in repo. And that's really the issue. Now,
and what is the drain on reserves other what is the drain on reserves that will be that is going to partially offset the potential injection of 20 billion a month that you foresee?
Well, I mean, okay, if you add the 150 of TGA drawdown to the 250, okay, what you're basically what you've got is a circa 400. Out of that, you've got to probably take something like 125, maybe 150 billion out for increases in cash and circulation,
Mhm.
because that's what the real economy will require. And therefore, you're left with probably somewhere near a 250 billion, which is the increase that you see from the bottom of that chart up to where the dotted line, where the red dot, where the orange dotted line is. So that's the increase back again, and it still falls below that 3.3 trillion. Now, why does it matter? Because if you look at this chart, it's saying here is the deficiency or the surplus of excess reserves of banks. In other words, the earlier chart, that differential between the adequate reserves is plotted as the orange line there, and the black line is trade fails in among primary dealers.
So a high number
So,
indicates stress, but that's the bottom of the chart.
yeah. So in other words, that black line showing trade fails has been inverted. Okay. So if the black line is going down, you're getting increasing trade fails. And the orange line is saying this is measuring either the surplus at the top of the chart or the deficiency in adequate reserves as you go down the chart. So at the moment, we're about 250 billion of shortfall. And that is consistent with something like, 200 billion of trade fails on a weekly basis. So that's pretty much where we are. Now, that would suggest that if you continue extrapolating this forward, you're going to accumulate an awful lot of trade fails. Let's not say it can't happen, because it can happen. But the last time it happened in size was in 2021-22, when you saw the Federal Reserve tightening quite aggressively after, when inflation was a real problem. After the COVID boom, they took liquidity out, but that wasn't particularly great for markets. Now, question is, why is the Fed coming up with this number? And I can try and explain it this way by saying what the Federal Reserve is looking at is reserves. Think about that, these two lines, reserves either as a percentage of GDP, which is the Fed's metric, or my metric, which is basically bank reserves relative to debt. Now, if you believe that bank reserves are used for transactions in the economy, then I'll come quietly and say, okay, the black line probably makes some sense. But my view is that bank reserves and liquidity are all about debt refinancing. So if you have a bigger debt pile, you're going to have more liquidity. And if you look at that orange line, that is showing the ratio between banks' reserves, US banks' reserves, and debt in the hands of the public. Both not dissimilar figures. I mean, in the low percentages, but they're different series. Now, the point that I would make is that if you look at the Fed target, which is 2.7 trillion for bank reserves, that looks to be somewhere around about the middle of the black line range. So the black line is reserves to GDP, and it looks like the Fed set itself a target to say, well, okay, we don't really know what the right number is, but let's choose a target which is somewhere in the middle of the normal range that we've experienced. And fair enough, that looks to a reasonable guess. However, if you look at it compared with the orange line, which is banks' reserves to debt, what you find is that it's actually right at the bottom of the range. And the last time you went right down to the bottom of the range was 2019, just ahead of the repo crisis. So, hence things are beginning to line up. And that's the problem that we foresee. Now, what does this mean? Well, if you look at this chart, which is looking at or projecting Fed liquidity, which remember is the factor which drives bank reserves and drives money market liquidity. It's the actions of the Fed in the markets, how much liquidity they provide. That red line is slated to move in the fashion of the red dotted line that you see extrapolated or projected through to the end of 2026. Looks very similar to the bank reserve number, but that's what it should do. So what you've got here is Fed liquidity effectively flatlining at best, but giving a sort of fairly limp rebound. But this, remember, is absolute terms, not growth rates. In growth rate terms, it looks even flatter. The orange line is the S&P, and I've lagged the S&P by 6 months to try and show very crudely that Fed liquidity matters to the S&P. This is not the whole story. I mean, obviously not the whole story, but it's an important ingredient in the mix. And if you start to see significant deterioration in liquidity conditions, what you'll see as well is a much weaker stock market. And you've seen that association before. Now, before, people would say, or ask the question, well, what happened before 2008 when you see that sort of L shape in the chart? What happened then was, obviously, central banks were not the main drivers of liquidity in the system. It was shadow banks. Remember those? And shadow banking booms or busts really was responsible for the gyrations of the market through the early 2000s. And when you started to see the shadow banking system imploding, as you did around the time of the Lehman crisis, then the Federal Reserve and other monetary authorities had to step in and inject lots of liquidity to replace that lost cash. And hence you now got a cycling QE or QT, which is really driving the markets.
Right. Michael, I've got a question, which is the shadow banks back then, a lot of them were hedge funds, variable interest entities, off balance sheet vehicles, structured investment vehicles, SIVs, that ultimately ended up being very tied to the banking system and caused a global financial crisis. It was horrible. Shadow banking now is reemerged, and it has a new name, slightly more boring name of non-banking financial institutions. And a lot of the repo financing, which is financing the U.S. government debt to the Treasury market, that's in hedge funds and giant hedge funds. It's not like $100 million hedge fund. It's like giant hedge funds. It's very, very institutional.
Mhm.
And then also this huge growth of private credit. What is the connection between the Federal Reserve and these new forms of shadow banking, or these that have kind of reinvented themselves? And also, I'll say that maybe the answer is, if the answer is not much, I'm sure your work has a lot to say on it, because your measure of global liquidity relies on three legs. Only one of the legs is central bank liquidity. The other is cross-border flows, cross-border liquidity, and then the private sector liquidity.
Well, the connection is clear. It's called repo.
Mm.
You've got the repo markets, which are growing at about $1 trillion a year. Okay. And who's ultimately supporting the repo markets or providing a lot of the cash into them is the Federal Reserve. And they have to, because this is the marginal financing vehicle for not just the US economy, but for the world. This is critical. And these markets are probably going to get even more important in the future, particularly if you've got a world where stablecoin is becoming a key instrument. So, these are the now and the future. So I think that's pretty critical. Well, they're pretty critical in that mix, and the Federal Reserve has to support them. Okay, and you can say, I mean, without maybe a lot of exaggeration, if you thought the euro dollar markets were the sort of the critical nexus of global liquidity in the 1980s, 1990s, 2000s, then it's the repo markets which have really taken on that mantle more recently. The euro dollar markets were under probably no one's control. The repo markets are at least under the Fed's control, but the Fed has to massage them. And these markets have got they're rapacious. They need feeding, and you risk at the end of the day getting your hand bitten off if you're not careful. And the Federal Reserve has got to be careful here. But the fact is that's repo is so important. And I think one's got to contrast, or one's got to think about, how financial markets have changed a lot in the last few decades. And, one thing that I've already said is that financial markets are no longer really new capital raising vehicles. They're much more debt refinancing mechanisms for this vast amount of debt we've got. I'm not advocating debt. I'm just realistically saying we've got what we've got. Okay. The other thing is that who are the players in the markets? Well, when I started my career, 3 or 4 decades ago, the fact is it was the big long-term funds, the pension funds and the insurance companies that were investing our savings. They were tended to be unleveraged institutions, and they were basically using conventional yardsticks like PE multiples, yield spreads, really to make their investment decisions. And they were shifting using, let's say, a 60-40 equity bond benchmark between different asset classes. They were doing systematic asset allocation. It doesn't happen anymore. I mean, what you've got are very highly leveraged players who are getting their funding through repo markets. They're basically using derivatives to get even more leverage. Okay, and it's the ebb and flow of liquidity, or the ease or lack of ease in borrowing, which is really driving the system. And it's really a question of understanding this global liquidity cycle, which I think is really important to. I think very important to understand for understanding how asset markets in general work. Doesn't mean to say that buying cheap stocks is not a great investment strategy. That still works. But at a market level, it's very, very different. You've got to actually watch these liquidity flows because they can actually swamp, intelligent investment decisions.
Michael, where is so much of the liquidity that we see today? I'll give you an example in a second, but where is it coming from? Because it's pretty clearly, I would say, not coming from the Federal Reserve, but all of these funds being launched, all of this money being raised in private credit, these super rich valuations in the stock market, all this money flowing into the bond funds, the money market funds everywhere. Where is that money coming from? It's money has a it appears money kind of just appears out of nowhere and then it disappears, and then during a crisis you realize that it actually wasn't money, it was just credit. But all of this money that's just sloshing around the system, tons of liquidity, where is it coming from if it's not coming from the Federal Reserve?
Well, let me say there are there are other areas. There are clearly other areas. I mean, one is foreign central banks that I'll come on to, but the other thing is that what you've been seeing recently, courtesy of the fact that you've got this collapse, I suppose, in bond volatility, is that let me evidence that. So if you look at the collapse in bond volatility that I alluded to, really since middle or early 2022, bond volatility has come down dramatically. That is actually allowing the collateral multiplier in the system to actually expand significantly. And the collateral multiplier is basically saying how many times can you lever existing collateral with or to get more and more credit. And if you have a very low level of volatility in that collateral pool, the collateral pool is dominated by treasuries, US treasuries, to some extent German bunds. But if you've got very low bond volatility, credit providers like banks will give you a much smaller haircut on that collateral, and you can leverage it much more. And the fact is, you've had this drop in volatility. Now, the cynic in me says, well, perhaps that's actually been deliberately engineered. The Treasury wants lower bond volatility for a whole lot of reasons. One is to maintain the hedge fund basis trade, and hence the buyback strategy that I alluded to. The other thing is actually going down the route of issuing lots of bills. Now, it's a little bit like drug taking. Is in the short term, this works pretty well. Bills can be issued with alacrity because there's so many buyers of bills in the system. So you can fund your deficit. The trouble is that it's not a particularly prudent strategy. And as Stanley Druckenmiller, the famous US investor, said 2 or 3 years ago in a speech, the sort of numbers that are coming out of the Treasury here in terms of funding through bills, this was when Janet Yellen was doing it, he said is much more reminiscent of a Latin American economy than the US. And, never was a truer word spoken. I mean, it's absolutely true. I mean, the danger we've got in the world economy is that because this has been such a successful strategy for both Yellen and Scott Bessent, we're now seeing other countries like Japan and Britain copying it. So you're getting a lot of governments worldwide turning towards the bill market for their funding because it's so easy. The trouble is it always ends badly because it's monetization. And that's really the problem. The other country we've got to take into account here is that is to look at what's happening in Japan. In China. And this is illustrating PBOC net liquidity injections. Now, the 2 lines on that chart are basically showing liquidity injections and a rolling 6-month total of that. And you can broadly see the picture. And this is high frequency data. So we're looking here at weekly plots. And through 2025, there was a noticeable pickup in the injections of liquidity by the People's Bank. Now, I think that has been forced on China for a number of reasons. One is because of the parlous state of her economy, particularly in the wake of the tariff threat, etc., and also because of the threat that came through from stablecoin, has actually forced China to say, look, we've got to start to get out of our debt problems. We've got to monetize debt. The only way in a modern economy that you get out of debt, believe me, is to monetize it. You can't default it because it's the collateral in your financial system anyway. So if you default it, you basically turn the lights out. So you've got to monetize it. You've got to print money, and that's what China has been doing. That's why the Chinese bond market yields have gone up. This is why the Shanghai stock market is so elevated. This is why the gold price has gone up dramatically this year, in my view, because the Chinese have been doing this. The Chinese themselves have been buying gold as a result to protect themselves. But now what are you getting? That is beginning to roll over. And we've seen in the last 4 weeks quite a noticeable drop in the scale of liquidity injections in China. Now, it could restart, but let's not mistake a blip for a trend. This could be a trend downwards. And there's only one person who knows what is happening in China, and that's Xi Jinping. And no one's inside his head. So we just don't know. But it looks as if that strategy of monetization may be cooling, to say the least, for the short term. And that's something else one's got to think about in the context of global liquidity. So, I'm by far and away not the biggest bear out there because I've been bullish for so long. But I'm starting to feel a bit cautious here.
Michael, thanks so much for coming on and giving us an update on your views on the Fed's balance sheet as they've evolved. I've been enjoying reading your Capital Wars Substack. You put out, 5 or 6 pieces since we spoke last? So, nearly a piece a day. So subscribers have been getting a lot from you. We do have our discount where Monetary Matters listeners can get 20% off an annual subscription to your research at Capital Wars. That discount ends on November 11th. So very soon. When we recorded in late October, it seemed far away. But that is
it's upcoming.
Yeah, it is upcoming. So people should act accordingly. Thank you again, Michael. And until next time.
Great. Thanks, Jack. Enjoyed it enormously. Thanks a lot.
Thank you. Just close the door.